Welcome back, investors. Thanks for joining in. Today we'll be looking at Meta Platforms, a stock that has performed incredibly well since last year and delivered an earnings report that blew away expectations this week, causing the stock to pop by more than 20%, making it the largest market cap increase achieved by a company in a single day ever. Meta also announced a dividend of 50 cents a quarter and a $50 billion buyback plan, which is something we'll look at more later. Join me on today's stock analysis of Meta. If we head over to our stock insight tool, we can see that over the past years, Meta has performed actually pretty well. We've seen an uptrend in revenue for a pretty long time, which was halted in 2022. And we see a similar pattern with EBITDA, free cash flow, and the free cash flow per share. This was something that feared a lot of investors, making the stock go as low as, I think, $80. We can also see that the net income and earnings per share are back on track as well. The cash and liabilities have also gone up. Where in 2022, the long-term debt was still higher than the cash position, in 2023, the cash position is once again higher than the long-term debt, even when the long-term debt has increased as well. Meta has also been buying back some shares over the past years. This is something we'll look at in the next segment of today's video as well. And we can see that the operating cash flow is in a very nice upwards trajectory as well. The debt to EBITDA and free cash flow yield are looking very nice, above our metrics that we like. And the return on equity and return on invested capital are looking very solid as well. By the way, if you want to get access to this stock insight tool that we use on this channel, you can head over to our Patreon that will be linked down in the description. And you can get yourself access to the stock insight tool as well. We'll be performing our valuation in this video in 3 steps. First is the margin of safety. In this segment, we'll be assessing Meta's key metrics and ratios to determine if we should be more or less cautious when determining our fair value. In the second step, we'll be performing various valuation models to see what the intrinsic value of the company is based on different metrics. And lastly, we'll combine the 2 steps to give us a fair value of the company. To determine our final valuation of the stock, we'll be using a margin of safety. This margin of safety is based on the ratios, the financial health, and the growth of the company. We'll be using a standard margin of safety of 25% that can never go below 0%. And the margin of safety will be based on a bunch of metrics and we'll be rating them on a scale. And if we use 4 colors in a scale, red will mean a 5% increase in the margin of safety, orange will mean no change in the margin of safety, light green mean a 5% deduction in the margin of safety, and bright green will mean a 10% deduction. When we'll be using 3 colors in a scale, bright red will once again mean a 5% increase in the margin of safety, orange will mean no change in the margin of safety, and bright green mean a 5% decrease in the margin of safety. The first metrics that we'll be looking at are based on growth. I will be looking at the earnings per share growth and the free cash flow per share growth of Meta. If we look at the earnings per share growth, we can see a very nice upwards trajectory, going from $1 a share in 2014 to over $15 a share in 2023. This is an EPS growth of almost 50%, which is in the bright green part of our scale, indicating a 10% deduction in the margin of safety. If we then head over to the free cash flow per share, we can see a pretty similar pattern. It went from $2 in 2014 to over $17 a share in 2023. And once again, the average growth rate is very large, sitting at 37.65%, which is once again in the bright green part of our scale, indicating yet another 10% deduction in the margin of safety. If we then move to the financial health of Meta, we'll be looking at 2 metrics, the debt to EBITDA and the Altman Z-score. To determine our debt to EBITDA, we have to look at debt, the cash, and the EBITDA of Meta. I just noticed that this graph is not completely correct. The middle part is supposed to be the cash, and right is the EBITDA. We can see that the cash position of Meta is currently greater than the debt position, meaning that they already have no net debt. And this causes their debt to EBITDA to be sitting at minus 30%, which is then again in the bright green part of a scale, in this case meaning a 5% deduction in the margin of safety. Next to this, we have the Altman Z-score, and the Altman Z-score is a model that is used to see the likelihood of a company going bankrupt. So it looks at many aspects of the business and looks at stuff like working capital, retained earnings, total assets, the market capitalization in comparison to the total liabilities and assets. And since Meta is looking very healthy, the Altman Z-score is very high, and the higher it is, the better it is. And the higher the score, the better the financial health. So we can see that above 3, we deduce a margin of safety of 5%. And since it for Meta is 11.8, that's looking very good as well. So once again, a 5% deduction in a margin of safety. We also have the shareholder return. Since Meta has not paid any dividends yet, we will not be including this metric, but they have been buying back stock. In 2015 and 2016, and also 2017, they've been diluting shareholders quite a bit, but they have been buying back a lot of shares as well. And if we look at it in just the past 10 years, they have done buybacks worth of 0.09% of the shares. So this is in the orange part of our scale, meaning no change in the margin of safety on this metric. And lastly, we have the capital allocation metrics, where we look at the return on equity and return on invested capital. With the return on equity, you have to look at the net profit divided by the equity. And anything higher than 12% is something that we really like to see for both metrics. The return on equity for Meta is sitting at a very solid 21%, meaning that shareholders are getting a very good net profit for the equity. If we look at the return on invested capital, we of course then look at the EBIT times the tax rate and then divide it by the invested capital to see how well the management is allocating the capital towards new investments. Again, this is really good for Meta as well, sitting at 23%, which is well over in the bright green part of the scale, indicating yet another 5% deduction from a margin of safety. This is looking all very good so far for Meta, but let's look at the intrinsic valuation models next to determine the company's value. Before we do any valuation models, we have to determine the weighted average cost of capital that we'll be using in these valuation models to determine our discount rate. In this case, we'll be looking at the cost of debt for Meta and the cost of equity. And the cost of debt, as we can see here, is 2.38%, but we have to take taxes in account as well. So we get an adjusted cost of debt with this of just under 2%. If we try to determine the cost of equity, we get 8.6% based on a risk-free rate of 4% and a market return, well, an average market return of 8%. Weighing both of these costs gives us a weighted average cost of capital of 8.34%, which we'll be using in the next models. And the first model that we'll be using is the discounted cash flow model. As we can see, the free cash flow has grown a lot for Meta over the years, achieving a almost 31% average growth rate in their free cash flow. In this valuation model, we'll be using a normal case, a best case, and a worst case scenario in their free cash flow, where the normal case will have a 10% short-term growth, 6% long-term growth, and a perpetual growth rate of 3%, which will be a perpetual growth rate that we'll be using in the other cases as well. The best case will have a 15% short-term growth rate and an 8% long-term growth rate, and the worst case scenario is a 8% short-term growth rate and a long-term growth rate of 5%. This gives us a sum of just over $1 billion that the company is worth, which gets increased to $1.05 billion if we take into account the cash and equivalents and the debt that Meta has. If we divide this by the amount of shares outstanding, we get an intrinsic value of $473, and with the current price of $475, this means it trades very close to its fair value based on this model. If we then head over to the discounted dividend, this one was quite difficult to fill in since we don't know a lot yet, but I've already filled in the $2 that we expect in 2024 in dividends, and I've applied a short-term growth rate in the dividends of a pretty conservative 10% and a long-term growth rate of 8% in their dividends. If we then also look at the WACC of 8.3%, this gives us a sum of $601 per share, which is a value that is almost 27% higher than today's price. The third valuation model that we'll be using is Graham's valuation formula, where we'll be looking at the earnings per share that Meta is generating, the long-term growth rate projected by analysts, and the current AAA corporate bond yield, which is currently sitting at 4.5%. And we go by the theory of Benjamin Graham that a PE of a company that is not growing at all should be 8.5. And if we then look at all of these metrics, we get an intrinsic value of this model of $560, which is almost 18% higher than today's price. And the last model that we'll be using is the mean reversion theory. In the mean reversion theory, we go by the theory that a company will always trade above or below its mean, and the metrics that we use to determine this are usually the dividend yield and the PE ratio. But since Meta has not paid any dividends before this, we'll not be using this metric in this model. We can, however, look at the PE ratio, which shows that on average, in the past 5 years, the PE ratio of the company has been sitting at just over 25, while the current PE ratio is sitting at almost 32, meaning that it's currently much more expensive than it has been on average. This is a deviation of 26%, which means an intrinsic value of $352. And this mean deviation is then the exact value delta that we get as well, meaning that it's 20% overpriced, meaning that we get an intrinsic value that is 26% below the current price. Now that we've looked at all of our valuation models, let's go look at the final overview of our valuation next. Looking at our final overview, we've imported discounted cash flow, discounted dividend, Graham's valuation, and a mean reversion theory price per share. We have not used the multiple valuation since I couldn't find that many similar companies to Meta. The only one that came to mind was Google, but I'm not gonna do a multiple valuation with just one company. That doesn't seem very fair. Out of the models that we did use, we get an average price per share of $496. A margin of safety we've determined earlier, using a standard margin of safety of 20%, deducting by 10% for the EPS growth and free cash flow per share growth, and 5% for the debt to EBITDA, Altman Z-score, return on equity, and return on invested capital, which means it usually would have gone below 20%, meaning that we would be paying a premium. But since the margin of safety in our system cannot go lower than 0%, we'll be using the 0% margin of safety in this case, meaning that the intrinsic value is the same as the average out of our models, and with the current price of $475, we get an upside of 5%. If you do not want to use this way of determining a margin of safety, and let's say we would apply 20%, we can see that there is a downside on Meta currently of 13%, meaning that the stock is actually overvalued. I hope you enjoyed watching this video, and I hope you enjoyed all of the new things that we added to our stock analysis as well. Let me know in the comments as well. And also let me know if there's any other companies that you would like to see me cover on this channel next. Thanks for watching.